One of the most common misconceptions we see from fund managers, GPs, and IR teams is the belief that your cost of capital should be slim to nothing. What we see all the time is the belief that a good deal, a really good white glove team, and a strong track record will get you capital at almost zero cost. The interesting part of this is that when you compare traditional channels to paid advertising through platforms like Meta, oftentimes paid ads channels and digital marketing will outcompete your existing channels while costing less. So it'll be the same cost, if not less, while raising more capital in shorter periods of time. And so in this video, we're gonna cover the reality of your costs when raising capital with paid ads. We're gonna cover what actually makes up your cost of capital. We'll go over the different alternatives, which I think this is the most interesting part. We'll compare paid ads to raise capital to placement agents, to internal teams, to doing it yourself, and all of the other traditional methods out there. And then we're gonna cover the one thing that everybody misses when raising capital with paid advertising. And it blows my mind that this isn't talked about more. So here's the reality of things, guys, is raising capital costs money. It costs resources. And the interesting part to this is it doesn't just cost your dollars, it also costs time and it costs headspace. Now, time is very objective, and this is a metric that you can measure, which is why we'll cover this first. But if you think about your entire role inside of a fund or how a fund operates, oftentimes people are concerned with timelines for raising capital and timelines to project completion or to exiting whatever project you're working on or developing whatever you're developing. You'll be very focused on those two timelines. But what people don't think about is the bridge in between. Instead of being concerned about when you need the capital by, think about how long it's taking you to actually get that capital in. And not just from I speak to person at this time to capital hits the account at this time. Think about it more from an individual sales rep perspective. If I have my salespeople or my investor relations team going to events, doing outbound prospecting, I am losing my ROI per sales rep. If we take what we typically do in the education space and we compare it to capital raising, we have a metric called ROAS per rep, return on ad spend per rep. What this metric measures is of the dollars I give this individual, how much money are they making me back? The person that makes me the most money, I'm going to want to give the highest quality calls to and the most calls to, and I'm going to want them to be on the phone talking to qualified prospects 24/7. For some reason, this principle does not apply to raising capital, or people with teams do not think about this concept. And you'll spend half your day outbounding when if you just talk to qualified leads, qualified accredited investors, you'd have a much better time. That's like the number one thing with raising capital here is understanding not just your timeline to capital and your timeline to project completion or return, but how much time are your reps spending actually talking to qualified investors. And traditional methods usually takes a lot longer and they have less talk time speaking to those people. So that's the one thing. The second thing that's extremely important in the reality of this all when raising capital with paid ads is your headspace. So if you think about the last time you got a really bad night's rest, you didn't sleep good, you feel kind of like this guy here. What happens is the next morning you wake up and you do the bare minimum, you do the work, but your output's much lower and you can feel it. When you run traditional teams, the same thing can happen to where if I have a bad call and my entire organization is extremely reliant on manual outbound, manual teams, if I have a bad call first thing in the morning or a rep has a bad call first thing in the morning, it can derail their entire day. Your ability to manage headspace with paid ads is much higher because there's no personal tie to these people at first. You can have much more logical, direct conversations, good sales conversations without being worried about what your mother-in-law thinks or your father-in-law thinks or your cousin of your cousin thinks. That's the second part here is headspace. Because when it comes to your cost of capital, again, like I mentioned and what we'll cover here in a second, is paid ads oftentimes cost less and allows you to compress the amount of time salespeople are spent doing whatever. So your capacity for relationships out of an individual rep can increase drastically. The amount of relationships that a rep can maintain will go up because they don't have to go out. Again, if you're doing deals in Texas or you're doing deals in Florida, you can get investors from Washington or Vermont very, very easily. That's the power of digital marketing. What does this actually break up into? Well, there's a couple of things. Number one, you have your ads. This is the production of ads, the scripting, the filming, the editing. Very, very simple, needed expense. Second one, you have your ad spend. And this is where majority of your cost of capital comes from, is the ad spend itself. After that, you have your funnels. This is the website that collects all the investor info. This is the production of the video, the assets that you provide on those web pages. And then lastly is the production of what we call sales assets, which a lot of funds already do that. If you aren't already doing this, please do it. If you want to know what we actually use for sales assets, there's going to be a link below where you can book a call to speak to myself or a member of the team. And again, this is going to be the larger time investment on your end, but it's a huge asset to nurture people over the long run and then be able to redistribute over extended periods of time. It allows for more of a white glove process with your salespeople. And so those are like the three core things is your ads, your funnels, and your sales assets. And like I mentioned, majority of it goes into ads. Now, typically what you'll see with paid advertising funnels is you'll be sitting at around a 2.5 to a 5% cost per capital. We've seen people go into 2, but I like to be conservative. The key here that I believe is extremely important for you to understand is that when you first launch, you may be sitting at 8%, sometimes even 10. And as you buy more data, your cost per capital begins to dip. Because with paid advertising, this is what I love. And this is where as soon as this clicks in a fund manager's head, everything changes. All you're doing with paid ads is you're buying data. And so I put $1 in to then see some information and then get more dollars out. That's it. And so in the context of raising capital, if I put $1 in and I now figure out that XYZ type of person is more likely to convert for raising money, or we can raise more capital from XYZ type of person, well, then now what I can do is I can go change the ads, raise more money from those specific types of people. And it becomes this just self-refining loop of improving that. The last thing that I think is extremely important is not just the cost savings or how much it actually physically costs, but the time savings. Because if I have somebody coming from an ad to a rep, sales rep on IR team, investor relations, whatever it is, that is going to cost significantly less time than if I go and network. If I network, it's probably going to cost me 5 to 10 times as much than an ad. Because I've got to go meet this person. I've got to go then figure out a lot of the qualifying info. So I've got to qualify them. Then once they're qualified, then I get to the sales call. Whereas with an ad, they give me all the info up front. I have a 2-minute convo to qualify them over the phone, and then they speak to a person. Instead of spending hours talking, not to mention drive time to events, in doing the networking thing or the personal relationship thing or even the cold outbound thing, I can say, cool, this person has raised their hand. They know what they want. Let me just double check. Cool, let me pass you on. Or you just take that convo right into the call if you don't have any SDRs. So there's that. The other part with your cost per capital that's extremely important to understand is you no longer are location dependent. If I'm location dependent, there are only so many investors in my area that I can go shake hands with. Whereas when I run paid ads, all of a sudden, it opens my whole world up. If I'm in Florida, I can speak to people in Texas. I can speak to people in Washington. I can speak to people in Europe that are investing in the US market if I really want to. I don't recommend that, but again, to explain the principle. So that's the other powerful thing about paid advertising is you now expand your TAM. Think about it in that perspective. If I can extract more money from the market, my costs relative to what I can extract decrease. That's like some of the fundamentals in terms of your cost per capital. Again, if you want to learn more about what like the specifics of it is, you can book a call. We can dive into it more in terms of like what to expect from an ad spend perspective. Typically, we're seeing $30 leads, $30 to $60, around $200 to $400 cost per call, sometimes $600. Just depends. Again, really just depends. A lot of this is based off messaging. I've got a whole nother video on that if you want to check that out as well. But again, you can book that call, learn a little bit more. Now, here's where it gets really interesting. We've covered the reality. We've covered up what makes up your cost of capital when running paid ads. Let's compare it to the alternatives. The number one thing that we see people always talk about is a placement agent. I don't even have to go into too much detail here. Here's what I find interesting. Let's say they have 1.5 to 2.5% success rate. Let's say they have a 10 to 25K a month retainer, plus your tail period costs. And let's say you're raising $20 million. This comes out to 420K to 1.1 million, which is roughly 2.1 to 5.5% before the tail period. With the tail period, you're easily crossing 4 to 8%. Compare that to paid ads, which is 2.5 to 5%. Makes sense. Yeah, people oftentimes will bias towards a placement agent. Now, the other route you can go here is your in-house team. Let's say you have a director, an associate. This can cost you between $230 and $440 grand. Let's assume you're raising $20 million. This is going to take you roughly 12 to 18 months, which if you go and you look at those costs, that's going to be roughly $230 to $660 in payroll. On a $20 million raise, that's 1.2 to 3.3%. Once you add in all the other costs like your CRM, travel, that's a big one, tech, benefits, etc., you're up to 2.3 to 4.4. And now we're right in line with your cost per capital for paid advertising. And let's just say your raise goes from 12 to 24 months, you're up to 4.6 to 8.8% over a 24-month period because you rely entirely on a network and the handshaking and kissing babies. Again, you compare that to raising capital through paid advertising at that 2.5 to 5%. I'll let you do the math there. So the next one that I find very interesting as well is leaning on the referral network. This is going to cost you a VP at roughly $350 a year. And then referrals alone can realistically bring in like 5 to 10 million. Again, this may be different for you, so don't take it as the gospel, but just what we've seen traditionally. On 5 million raised, it's roughly 7% of cost per capital. On 10 million raised, 3.5%. Again, depending on how good your VP is, they may pay for themselves. So I'm not knocking this strategy at all, but the one thing you'll notice is it's not predictable. So just be aware of that. And if the raise stalls, it's going to cost you that 350 regardless. That's like, what's that, 30 something grand a month, roughly? Which then again brings us back to Facebook ads or paid advertising. This is going to be specifically through Facebook. 100% of that spend goes to finding accredited investors. And here's my favorite part. The more money you put in, the faster you can raise. You can control the speed at which you raise capital. Again, assume the 4 to 6 to sometimes 12-month sales cycles. But generally speaking, as a rule of thumb, if I take the upfront risk and I put more into my paid ads, I get access to more investors, which means I will raise more money faster because I can predict that engine. If I say, ooh, I don't want to be spending as much, I get a little nervous, I can just pull back spend. Again, I'll bring in less investors, but I can pull it back. I can control and I can throttle my actual expenses relative to cost. What is so awesome about this channel is the more capital I want to raise, all I got to do is raise my ad spend. That's it. I don't have to hire and hope. I don't have to think somebody has a good network. I can just put money in, know exactly how many LPs I'm gonna get out, and then just make sure my sales team converts at a certain rate. And as you spend more, as you raise more, you begin to collect the internal data to then make decisions from. When people say paid advertising is too high at 2.5 to 5% cost per capital, well, look at it compared to your referral network. Look at it compared to your in-house team. Look at it compared to a placement agent. Like, really do the math on what it costs for these other channels. And if it doesn't make sense, it doesn't make sense. But if you start to look at the numbers separate and you realize, hey, maybe it's a little more expensive, or maybe it's right on par, or maybe it's cheaper, is it worth paying for the machine? That's all I want you to think about, because ads are the only one with no fixed costs associated with them. It's just ad spend. It's the production of the assets and the ad spend. You don't produce assets unless you're going to spend money on ads. It is the only one that has variable costs that are directly correlated with the amount that you raise. It's how you create the machine. Because here's the part that everyone misses, is most people are focused on front-end acquisition. How much is it going to cost me to get a new investor? Once I have that investor, though, they're in the pipeline, which means if we can't get them for the first raise, maybe we can get them for the second. The longer that you run ads, the bigger your accredited investor network becomes, the more you're able to pull on investors that weren't quite ready 12 months ago now. Your back-end selling systems come into play. Because here's what's interesting. Over 79% of LP dollars are repeat money. These repeat LPs also cost 1/3 to close. And let's say you spend $5,000 to acquire one investor that invests $100K with you over, let's say, 3 years. That's less than 1% cost of capital. There's no other method that gives you that concrete of math in terms of what to expect. And again, you're only rewarded for running ads over longer periods of time. If you just want to learn a little bit more about what running paid ads for your fund might look like, whether it's on a consulting basis or we do it for you, there's going to be a link below this video. You can click, there's going to be a little application, fill it out, book a call, you speak to myself, or member of the team to learn a little bit more about what raising capital paid ads actually looks like. Like, subscribe. I hope this was helpful in some way, guys. I recently had this question come up on a call and I thought it'd be useful to make a video about it. Again, if you have any questions, drop them in the comments below. You want more content like this, let me know, and I will see you in the next one.